Good morning, everyone. Righto, it's just hit 9 o'clock, so we'll get today's cash flow management webinar underway for you all. My name is Rebecca Connor, and I'm one of the senior managers here at BDO Central, and I will be your moderator for today. At BDO, we are chartered accountants, and we are business advisors. Our central office covers both the Manawatu region and also the Hawke's Bay region, and we're lucky enough today to have a partner from each office presenting to you, and very shortly I will introduce both of them to you. Just a quick note, it's really great to have you all on board today. Everyone's got a lot going on and everyone's very busy at the moment, so a big thank you for joining us and giving up your time to be here. Hopefully everyone will enjoy the webinar, and I'm sure you'll get a lot out of it. Right, just before I hand over the reins to our presenters, just a wee bit of housekeeping to cover off. We are running this event through Microsoft Teams, so everyone who is attending will be on mute throughout the webinar. We have allowed some time at the end for Q&A, so if you do have a question, if you could just click on the little chat box and then click on Ask a Question, and then if you just pop your question in that question box, and that'll come through to us. Now, just remember that only we can see the questions. Not everyone on the webinar can see the questions. We will endeavour to answer all the questions, but just in case we don't get through them all, if you could just pop your name and contact details in the question box with your question, that would be great. But we will do our best to get through all the questions. Right, now it's my great pleasure to introduce our two lovely speakers to you today. So we have Billie Stanley from our Palmerston North office, and Lisa Townshend from our Napier office. Billie is one of the co-leaders of our business advisory team. Her focus is really about helping our BDO clients to develop their business and work with them to understand their goals. Businesses have had some pretty big highs and lows to deal with as of late, with everything going on. So Billie's aim is really, along with the rest of the BDO team, is just to make sure her clients can sleep well at night, knowing that they have a plan in place. Billie's also juggling working full-time with raising 3 under 5s, although it's now 3 under 6s, as her eldest has just started school. So she has a lot going on. Now on to the lovely Lisa. Lisa's also one of our business advisory partners, and she's based in our Napier office. Lisa's also the HR partner for our firm. Lisa works with a whole range of SMEs, providing various business advisory services, including, of course, cash flow forecasts, which we're covering off today. Her client base includes commercial, agricultural, as well as clients who have investment portfolios. Her clients also cover a whole range of industries: automotive, pharmaceutical, property, retail, etc. Lisa's also one of the most fashionable people in our office, and she loves the colour pink. She's recently acquired a lovely new pink face mask in case our lockdown levels change in the near future, but hopefully they won't, and hopefully you won't need to use it, Lisa. Right, I'm going to hand over to Billie and Lisa now. Billie and Lisa are going to share the presentation today. Billie's going to kick things off, so over to you, Billie.
Thanks, Beck. I can certainly say, after having 3 kids in our house, that there's not a lot of sleep going on at the moment, and I was very grateful to get the kids off to school and vice versa, to actually get here on time today.
Yeah, good work.
So welcome everybody. Thank you for joining us. I certainly know it's a time where you've got competing priorities and situational pressures all gunning for your time at the moment. So I'm pretty stoked to see so many of you making some time to work on your business. Just wanted to make a special mention to Dennis. I hope that you managed to locate a great batch of scones to accompany you through this webinar today. Most of you registered today to have a quick sort of lift the hood on cash flow forecasting, I guess. Although what we will actually be doing as part of that will be re-strategizing your business just by taking a step back to get a clear view. But if you don't have a cash flow forecast in place, I can say that preparing a cash flow will be my #1 recommendation. And that's just to ensure that you're shifting gears and getting into a recovery mode and staying abreast of what may or may not happen for the remainder of the year. After all, I'd say that business as usual is a pretty relative term these days. So speaking of business as usual, what that means for us here at BDO is we've been embracing technology, and that includes writing articles and delivering webinars such as the one today. For those of you that may have missed our business recovery session, just give us a shout out if you're interested, or you could go and search the BDO website. It's got some great tips and tricks for you. Okay, so let's get started. So as far as accountants go, I'm going to start off pretty deep, and we're just going to set a thought for the session. It's a quote by Chris Chocolate, and it says, "The fact is that one of the earliest lessons I learned in business was that balance sheets and income statements are fiction, but cash flow is reality." So what we've been trying to find out is, does this quote resonate with SMEs? For me, I guess asking our clients that question has been a pretty sobering task, and that's because as an accountant, the answer isn't necessarily what we're always hoping for. And that's because time and time again, what I'm hearing is that you're being told you've had a great year, you made a solid profit, but you don't have the cash in your bank account. And what I'm realizing is at that moment, you're experiencing a trigger of frustration because you just can't pull all the pieces of your puzzle together. So my aim for today would be for at the end of this session, would be for you to feel better about your business financials, but also much more informed about how your business cash flow cycle operates. And that's really important because I hope that you're going to be able to go away and do something differently in your business. Try and find a way to have more cash, because that's probably, well, it is why you're here today.
That's right, Billie. And hi everyone, Lisa here. Thanks again for joining us. It's great to have you on board today. Failure to plan is planning to fail. Keeping the cash flowing, 5 principles. Having a lot of experience in cash flow management, not just for ourselves, but in helping our clients, we're incredibly familiar with the 5 key principles of keeping the cash flowing. Throughout this session, we'll be repeating these principles in various ways. Cash is the lifeblood of any business. Without cash, your business simply will not survive. What you might see as a very profitable business could fail simply because of poor cash flow. When a business is growing fast, often in a startup mode, it needs working capital to fund that growth. That's why it's called working capital, because the spare capital has to work really hard. The business has to pay for stock, wages, overheads, buy new assets before it gets to bank the cash from selling its products. The fact that a business is making a profit on paper and yet is cash tight is precisely why every business owner needs to understand their cash flow drivers. These are the business processes that affect your cash flow. Processes like how you order and pay for your stock, how you bill for your services, and how you make sure you get paid by your customers. Many of you here today would have been asked to complete a cash flow forecast for the bank, often because your overdraft is blowing out. When this happens, preparing a cash flow forecast is vital. In fact, I believe every business deserves a cash flow. This should be one of the things you do annually. It's simply best practice in business. And yet simply preparing a cash flow forecast every time the bank asks for one is not going to fix the underlying causes of poor cash flow. Borrowing more money from the bank is not a long-term solution, and it costs you a lot in interest. By looking for the underlying causes of poor cash flow and making some changes to your processes, you are not just treating the symptoms, you are treating the cause. This won't just help your cash flow, it will build a much better and more valuable business. Not to mention, it will significantly reduce your frustrations and stress levels.
Right, let's crack into the agenda. Hopefully, you've all got copies of slides with some spaces to write some of your notes and capture ideas. That's really important because today's going to be vital with writing down some of your actions. if you can come up with 3 key actions to put in place when you go back to your business, it's going to be a huge success. And that's a success because one of the biggest problems in business today is something that's called FTI. And that means failure to implement. So if you don't write down your actions, it's going to be really difficult for you to remember them. And we really just want you to get the maximum value out of today's webinar. So just to reinforce that, if at any time you have a question, if you could just use the Q&A function, we'll make sure to answer that at the end. So here's what we're going to try and cover in today's session. First, we're going to try and help you understand the difference between your profit and your cash, because really reading your profit and loss and seeing the bottom line and understanding where that sits in your bank account are 2 entirely different situations. Then we're going to have a quick look at your working capital cycle, and that's going to be to help you understand why your working capital is so important to your business, even more so if you're growing. Then we'll have a quick look at the cash conversion cycle, and we'll do an exercise to work out your cash conversion cycle in days. And that's going to be looking at how many days it takes you to convert your goods or services into cash. We'll also have a look at the your plan for cash flow improvement, and that's going to involve committing to preparing a cash flow forecast and just setting some general goals around improving your cash flow. We'll also follow on with launching into the 7 biggest causes of poor cash flow, and we'll consider some ways to improve business processes just so you can try and shorten that cash conversion cycle. We'll also be trying to address a number of best practice initiatives as we go through the webinar today. And that means that every business is going to need a cash flow, but more importantly, I think it's fair to say that every business deserves an understanding of the cash, and that's aimed around making sure that you're in a position to make informed business decisions. And then we're going to head into accountability time. And that's where you're going to have to decide what action points that you're going to take as a result of attending this webinar with us today. We'll keep the session straightforward, try and make it short and to the point, but I hope you have just a tiny bit of fun along the way.
Profit versus cash. Profit does not equal cash. I have a question for you. It's a webinar and I know I'm not going to get a response, but just have a think about it. Do you read your financial statements from your accountant? Be honest with yourself now. It's okay if you don't read them. We know that's often the case. Okay, so now think about this one. Do you understand the difference between profit and cash? If your answer is something along the lines of not really, we're not surprised. It takes a bit to get your head around the difference between the two. Profit is the money left once expenses are paid. Some people think business owners take profit to the bank, if only. Profit is used to pay for any new equipment or materials needed to grow the business. And unless you buy a politician or 2 or marry one, you still have to pay taxes. Only after paying for growth and taxes do you get to take the money home. Profit versus cash. A profitable business can go out of business simply because it's starved of cash. However, a business making a loss can survive because it has access to funds from investors or financiers. In the blue box, profit equals total sales less the cost of product and any other expenses, whereas cash equals all cash inflows less all cash outflows. I'll just quickly run through the box on the right so we get an understanding of the effect on profit and cash of each of these items. GST, this is an income or an expense, but it certainly has an impact on cash. Loan payments, these reduce a liability, but they aren't an expense, however affect cash. On the other hand, the interest part of loan repayments. This is the cost of having a loan and therefore is both a business expense and a movement out of the bank, affecting cash. Cash spent on buying assets. Assets are items that are used over and over again in order to grow your business. They aren't a one-off cost and aren't deducted from sales. So therefore, don't affect the profit and loss, but do affect your cash. Again, cash received when you sell these assets. Obviously, when you sell an asset, you get cash. However, it's not to do with business trading, and it does reduce your assets. Then, the mysterious depreciation. This is calculated to give you a tax deduction on the wear and tear of your assets. It's in anticipation of the fact that your asset will be worth less when you eventually sell it. It's not a real cash outflow. It's just an accounting calculation that affects profit. When the calculation of profit does not show, what the calculation of profit does not show is how much of the profit needs to be retained to allow the business to grow. In other words, to invest in more stock, materials and plant. Best practice is retaining 50% of the profit for growth. Available cash, on the other hand, is affected by how long customers take to pay us, how long it takes us to pay our suppliers, whether we are growing as a business and what we are drawing out of the business, our loan payments and tax payments, and any new assets we need to buy. The link between profit and cash is simply timing, and we call this the working capital cycle.
Thanks, Lisa. So we're nailing the difference between profit and cash. And as Lisa said, we're going to have a quick look at the working capital cycle. I'm sure most of you have heard of the term working capital before, but it's probably not a term that you would use on a day-to-day basis. But what it really just means, again, is it's just the timing difference between the profit and the cash, and that difference gets reinvested in your operational business. So on this slide, we've got two different cycles. On the left-hand side, it's a nice, easy service provider cycle. And on the right, we've got the retailer and manufacturing cycle, which is a little bit more complex. So I'm just going to talk you through each of the cycles. So if you're a service provider, your working capital cycle will look like this. You sell your services to your customer. Once you've invoiced your customer, that amount increases your accounts receivable total. That is what your customers owe you. But the money is certainly not in your bank account yet. It's sitting in your accounts receivable cycle until you get paid. And that, in essence, completes your cycle. But if you're a retailer or a manufacturer, your cycle will look like this. To make your goods, you purchase some stock or materials. You may have to pay some suppliers immediately. Some of your other suppliers, they're probably going to let you pay on the 20th of the month following. You're then going to manufacture your goods, and at any point in time, you're probably going to be carrying some work in progress, some stock, maybe even some unfinished goods. Once you receive an order for those goods from a customer, you're going to make the sale. You invoice the customer, and that amount then goes back in your accounts receivable ledger. And now again, you have to wait for your customer to pay you. So what we're really trying to extract out of these cycles is just show you that it takes some time, depending on the type of business that you've got, to convert whatever it is you make or sell or the service that you provide into the cash. So to understand the cash flow effect on this on your business, you really need to be able to calculate your cash conversion cycle. And let me show you what I mean by that. So I'm going to take a real example. We'll use a name, make it a little bit easier. Karen was taken, so we're going to go with Aaron today. So Aaron is a wholesaler of goods. Aaron will go and buy some stock from a supplier. And as I said before, he's probably got until around the 20th of the month following to pay for that stock. So let's say, on average, whenever you buy something from your suppliers, you've got about 35 days up your sleeve after buying the stock before you have to pay for it. But Aaron's not able to sell that stock the moment that it comes into the warehouse. So some of the stock will sell quickly, other stock will take longer, and the reality is you're probably going to have some stock that you're going to have to heavily discount just to get it out the door. So on average, Aaron's going to hold a stock for about 65 days from the date of purchase. Then when Aaron sells the stock, he's going to provide credit terms to his customers. But as we all know, there are always some ruly customers that just don't follow the rules and they don't pay when you want them to. It's an all too common scenario, I'm pretty sure. So that means that the average payment cycle for customers is about 45 days. So now we've got all the pieces of the puzzle to work out a cash conversion cycle. And this is going to tell you the total number of days that money is tied up. And that's money that's not being used elsewhere in your business, somewhere that's really useful. And it's probably going to be the times when you need to pay those big invoices or those lumpy payments, your GST and your PAYEs. So let's just take a really quick moment to tally it all up. So you've got 65 days for stock sitting on the shelf. You've got 45 days for customers to pay you. You get the benefit of the days that it takes Aaron to pay for his suppliers. So that's about 35 days. So in total, that is 75 days to convert inputs into cash. That is 2.5 months.
Think about that for a minute. 75 days to convert stock into cash. This would be pretty typical of a lot of businesses in New Zealand. And like Billie said, it's over 2 months. No wonder businesses simply run out of cash.
Exactly. And that's paying staff and overhead for 2 months before the cash comes in to be spent again. So hopefully it's fairly obvious that the shorter the cash flow cycle is, the better the liquidity is going to be in your business. And that just gives you flexibility, just that little bit of extra wriggle room for your cash. So what I'm hoping we can actually do now is just give you some tools to actually do the same thing for your own business. So don't worry if you think this is going to be a little bit tricky, or you go back to your offices or your businesses and you do find it a little bit hard. We're here to help you with that, so just give us a call. If you're a manufacturer, a wholesaler or a retailer, and you're going to calculate your cash conversion cycle, you're going to need to know 3 key metrics. And they are your average supplier terms in days, your average stock holding in days, and the last one is your average debtor days. Alternatively, if you are a service provider, you're going to need not quite the same information, but it's fairly similar. You're going to need your average supplier payment terms in days and your average work in progress days, along with your average debtor days. Again, don't be put off by learning these calculations. You will find them really difficult the first time, but they certainly get much more easier as you continue to calculate them.
Okay, so let's say you've calculated your cash conversion days. What's the impact on actual cash in the bank if you work to shorten the cycle? Let's now look at a worked example. This is a manufacturer example. The impact on cash flow of shortening your cash cycle can be incredible. Here we have an example with a manufacturer, initially with a cash conversion cycle of 75 days. By focusing on reducing debtor days by 9 and inventory days by 6, that's 15 days in total, the business has released more than $52,000 in cash. Is $52,000 off the overdraft or $52,000 in the bank account, however you want to look at it? Surely this must get your attention. Personally, I think this is an amazing impact. I mean, what business wouldn't want an extra $52,000? These are the sort of numbers we can help you calculate to see the impact of shortening your cash cycle. But you can't just release cash without doing something different. To achieve this sort of cash flow improvement, you need to have a plan.
Okay, so now we've just had a quick look at measuring how efficient your cash is. How do we go about improving it? What I've done is I've actually grouped our process into 4 key steps. And the first one is, and I'm pretty sure you all know that I was going to say this, prepare a cash flow forecast. and make this part of your annual business planning process. It's what our most successful customers do. They do it on a month-by-month basis. I'm going to ask you just at the moment if you could give me a bit of a helping hand. If you wouldn't mind typing into the Q&A session how you really feel about preparing a cash flow forecast. Perhaps you've just got no idea where to start, or perhaps you're actually really scared to take the project on, and that's absolutely okay if that's how you feel. The first time that you prepare one, it really can be quite confronting. We're talking about money and really facing some really tough cash flow challenges, especially at the moment. And I guess I want to say that that's really important, because those challenges, they're not going to go away. But when you do complete your cash flow forecast, I think that many of you really will find a sense of peace and a sense of relief once it's completed. And I can probably talk now about a real life example that I've been working on at the moment. So we just completed a cash flow forecast for a client after lockdown, and I'll just go through the steps and what it was like. So it was their first ever cash flow forecast that they had actually prepared. And the first cut that we undertook, it actually produced some pretty terrible results. Just to give you an idea, so negative cash result, they were running out of stock, they had no more cash to purchase anymore. So you can imagine what that felt like for that owner of the business. The bank wasn't going to lend them any money on the cash flow forecast that we'd produced. So it was a situation, I guess, of just going to have to go and fix it, or they were going to have to shut up shop. So where we got to is we went to work on resolving it. And the solutions, in fact, weren't necessarily about taking on any more debt. It was about coming to realise that there was actually a fundamental misunderstanding with how they were measuring their work in progress. So essentially their margins and deposits, they're actually out of sync. So what we had to do to resolve that is we had to overhaul their internal process. And as part of doing that, we were actually able to bring the bank on board. And we were able to do that because we changed the basis of the business model, and we just made it much more realistic. And I can say that it was certainly a really scary time for my client, but they're much better off because of it. They're still in business. They had a detailed look under the hood of their business. And without doing that, they wouldn't have realised their misalignment. And the reality was that they were going to go out of business before the year was up. But they've come out the other side, and I can tell you that they've also got a fantastic relationship with their bank, and they've built better communication, and it's absolutely a strong relationship. So what I'm really trying to get at is that by preparing a cash flow forecast, you're going to be able to predict those months where there's more cash going out than coming in, for example, especially when it's tax time. You'll also know in advance about any seasonal fluctuations, and you just won't be flying blind anymore on the issue of cash flow. The second point on the slide, that's all about what to do with the cash flow once you've got it. Many of you are on Xero, I'm sure, but whatever the accounting software or reporting software is that you use, just be sure to put that forecast into your accounting software, and that's so that you can report against the actual results on a month-by-month basis. And this is going to enable you to recognise where you are against your target, and you're going to learn to become much more aware and more comfortable, I would say, with your cash flow cycles and exactly where you can improve them. Number 3 and 4 on the slide, I would say that these are the real game changers for me. These are the two that actually make the benefit of doing your cash flow a reality. So number 3 is, I guess, just indicates that having a cash flow forecast is one thing, but using that knowledge to change how your cash circulate is an entirely different matter. To do that, you have to understand your cash conversion cycle and improve the business process behind it. And that really means having SMART goals. And we chuck the term SMART goals around all the time. But for those of you that aren't 100% sure what SMART goals means, these are goals that are going to be specific, they're measurable, they're achievable, realistic, and the most important one of all, they are time-bound. And then last of all, I really encourage you to have someone independent hold you accountable to your plans and your goals. Having someone encourage you and support you and talk you through those tough conversations as you work on your business is going to be the fastest and the easiest way to get ahead in your business. That person, they really need to be independent. And so what I'm trying to say is it's not going to be helpful if it's your spouse or your friend. That coaching will end up being too soft. So if you don't already have a business coach, it's certainly something that we can help you with, or even help you find the most appropriate person.
Right, we're now going to move into the 7 key causes of poor cash flow, and between Billie and I, we'll just quickly move through 1 to 7.
Okay, I'm going to take number 1, accounts receivable, first cab off the rank. So how are we going to shorten our cash conversion cycle? We're going to have to get faster payments from our customers. And I know there's quite a number of ways to do that, but I'm only going to focus on 3 of those here today. And some of them might even seem a little bit obvious, but the first one is to bill faster. You don't actually need to wait until the end of the month to send out your bills. If you can invoice your bills as soon as the work is completed, that's actually going to be the same time as your clients are experiencing what I would call a glow factor. That's the maximum point of satisfaction that they will have with the work that you've completed for them. So that's the ideal time to encourage them to pay you. Hopefully they'll do it just that little bit faster. You could also consider interim billing, doing it midway through the work or at set milestones. This is going to be especially useful for businesses that have a workflow that's slightly longer than usual. You could also consider making the payments functionality for your customers really easy. So I'm just talking about perhaps removing as many barriers as possible. You could consider online invoicing, making sure that you take credit card, direct debit, for example. The last method that I've got on the slide is a little out of the box. You could implement perhaps a Xero add-on, one that chases money owing to you. Debtor Daddy, for example. Don't be put off by the name. It's certainly not what you think it is. It's essentially a product where someone else will take care of the debt collection for you. And I can say for businesses where the owner is the main driver for sales, taking some time away to collect debtors isn't necessarily the smartest use of time. So if you are able to put a mechanism in place where that money is being collected by someone else, this again is a positive influence on the cash flow cycle. So moving on to the accounts payable processes, just make sure that you're across all of your major supplier agreements. Your payment terms, are you maximising your prompt payment discounts? Are you ordering efficiently, making sure that you can group your orders together and downplay the freight on your charges, for example? The second one that I've got there, it's probably a little bit on the cheeky side, but it's something to really consider. Ask yourself just what the best payment date is for when you're making your creditor payments. Make sure you're not paying too early. And if you can try and manage it, make sure your payment date is aligned to the period where most of your customer receipts are coming in. And that isn't always the 20th of the month, so it's definitely something that's worth understanding. And I would also say that that probably includes looking at staff wages. Just have a look at the frequency. Perhaps fortnightly is creating a bit of a problem, especially when you get 3 fortnights in a month. Maybe monthly is a better option, or actually maybe weekly gives you some level of certainty. Lastly, try and consider some spending budgets on a monthly basis. Making sure payments and ordering isn't too lumpy, that's going to make a really big difference on your day-to-day basis, on your day-to-day cash flow.
Number 3, the inventory process. Now, what are some of the ways we can shorten our cash cycle by moving stock faster? Firstly, you need to review your stock ordering system. Who orders, when do they order, and how much do they order? Secondly, I think you need to use technology better to manage stock reordering and slow-moving stock. Using technology is also a good option for printing out your monthly stock take, especially if you haven't got the resource to be able to manually do a stock take. There isn't a bullet point on it, but I think it's worth thinking about. How much stock do you lose by what we call shrinkage, which is really theft? Should you maybe consider a security system? On to you, Billie. Oh, no, me, number 4. Number 4 is the debt capital structure. Okay, so how do we improve our debt structure? Firstly, I think you need to review interest rates. You need to be considering fixed rates versus variable rates, and also consider interest only. Sometimes, especially for a short period, interest only can be a very successful option. Secondly, you need to be reviewing the terms of your loans. I personally think this needs to be done at least annually. Is the term now right for the business? Following along this line, I think you also need to consider when you're buying an asset, especially a bigger asset. Should you be buying it straight out of cash flow? Should you be financing it? Or is leasing even a better option? Finally, I think it's really important to review owner drawings. When we think about poor cash flow, what we've found with around 70% of businesses is that owner drawings simply don't match the business profits. When owners take too much out of the business, it's simple, the business bills don't get paid. I'm sure the bankers that have joined us this morning on this webinar would agree that this is often a difficult and problematic area.
Right, on to overheads. It's a pretty big topic. So assessing overheads really is just about safeguarding your cash. Again, try and do this annually. It's a bit of a theme. So I can also say when I say look at your overheads, it's not about, as an accountant, us telling you not to spend as much money. That's what everyone thinks accountants are trying to say. But really what we're actually asking you to think about is what you're spending adding value to your business. Is it working hard for you? Take marketing, for example. I've got a number of clients, and whenever we go through the cash flow process, the marketing is a pretty hefty bill. But a small reduction and probably a tweak to the type of marketing and the way the marketing is being done often results in a reduction in spend, but it also actually ends up as a better return on investment. I'd also recommend that you do a bit of a shopping round. Make sure you're getting the best deal when it comes to your overheads. Power is always a nice, easy one. I think that most people are familiar with the fact that if you shop around with power when your contracts are up, that you go and you shift. If you're not getting the best price, you'll be able to actually, if not save any money, at least keep that power spend where it is, at least, hopefully. Just make some smart supplier choices, really. Perhaps small changes can accumulate into some surprising results. The last one's really a specific example. Try going paperless and reduce some of those stationary costs. I can certainly speak from experience. We're now a paperless office. You'll still see a little bit of paper around the place, but it certainly has made a difference to our stationery costs. But what I'm really driving at is just trying to make sure that you check out new technology, really. Don't let those missed opportunities pass you by. It's something that's quite a challenge, especially with the way that the technology landscape is changing so quickly. But there's always going to be new products, and they will always change the way that you operate. So if you can get some visibility with that and harness that opportunity, you will be better off. Number 6 is about trying to understand if your gross profit margins are too low. And this again is a really big topic. We could spend a whole hour talking about that. Don't worry, I'm not going to do that. So our gross profit margin, that's what's left from sales value after deducting your variable costs such as stock for resale, materials, labour. And as I said, it's a really big one to tackle, but don't let it scare you. I guess my best piece of advice is probably going to be make sure you have some great software, and that's going to help you to analyse your income streams. And I'm sure that most businesses don't actually have a flat gross profit percentage. There's going to be some goods or services that you offer that actually they're reducing your budgeted margins. If you can go away and you can try and identify what's really working for your business and really worth the time and effort that you're putting into your business, then you can improve that, and you can decide whether or not that's something that you would like to continue. Is it essential, or possibly you could stop undertaking that activity, and that will leave you with a higher gross profit margin. I would also encourage for those of you that are performing jobs in a business and use job costing, give that some really detailed analysis. Even if the job outcomes are poor, try and work out what you can learn from those jobs. Why was the outcome poor? Why was the margin less than what you were budgeting for? Perhaps you could even look at some of that job costing a little bit more frequently just to get the best learning opportunities out of that. Of course, reviewing your gross profit margins needs to include ensuring that your margins capture all of your costs. Where are they coded? Are you missing any components of your pricing? It's also actually quite surprising how often that your suppliers are increasing prices on you. So you would need to understand if your costs are going up, that perhaps you might need to increase your sales price just to make sure that you're at least maintaining your gross profit percentage and you're not eroding your margins. Lisa, I'll let you take on number 7 and round us into the home base.
Thanks, Billie. And finally, number 7, sales are too low. There are literally hundreds of ways to increase sales. We've just put 4 up there. You need to look at increasing your customer retention rates, look at generating more leads, increase your customer conversion rates, increase your transaction frequency and the value of the sale. We feel it'll be much more effective if we go through the relevant ways for you to increase your sales one-on-one as part of our cash flow management coaching service. So don't hesitate to message us if you're interested in that. Okay, now that gets us through most of our webinar. So how can we help you? First way we can help you is our cash flow forecast service. This includes the preparation of a cash flow, including an hour review meeting. The cost of this starts from $2,750. Second option is what we call our cash flow management coaching. This is a 12-month program designed to maximise your cash flow potential. This costs $1,000 a quarter, and it includes the preparation of a forecast and 4 coaching sessions. Now, that said, we understand that vouchers to help with our professional costs are still available via NZTE, as we are a registered service provider. So it may be worthwhile contacting us to help you gain access to these funds.
Okay. Here's the next steps that I talked about earlier on the agenda. What I really want you to do is to identify 3 important tasks for you to take back to your business to try and make a fundamental change. And as part of doing that, there's going to be 4 possible courses of action from today's session. The first one is there'll be a number the first one could be that you will do nothing. And you'll be thinking, oh, that was an interesting seminar, but I just think I'll box on with what I've always done. There will be some of you that will go, I might go to the retreat option. Sounded pretty scary, a little bit hard. I think I'll go back to my business and hide. Third option, you might take a normal amount of action and you say to yourself, yes, I think I need a cash flow forecast, but I think I can do this myself. And I'll probably be a little bit blunt here, but most likely, in my experience, that this will lead to doing nothing and retreating. The fourth option, it's take a massive amount of action. And that's where you say, I get it, I know I need help. Perhaps BDO knows my business better than anyone else. So if you would like a proposal and a quote from us, please don't hesitate to contact us.
Great, thank you, Billie, and thank you, Lisa. That was really enlightening, and I'm sure everyone attending today would have got plenty out of that. That was great. I just want to say thanks to those of you that have submitted some comments and questions. They're starting to come through, so that's great. Billie, I'm just going to fire the first question at you, if that's okay. So question 1, sounds like a forecast would be a great idea. However, I don't know where to start with preparing a cash flow. What is the best starting point?
Okay, cool. I just need to get over the fact that I'm sitting here looking at a slide and I've got my face staring back at me. So, okay, so generally I'll just talk about how I guess we do it here in the office. So the first place that we typically start, and most of our clients actually have accounting software. So go to where you know. So go into your Xero file and pull your last 12 months and look at starting with a budget. So once you can get a really good budget in place, then you can go and add in the additional non-cash items. So start with a budget, work towards a cash flow forecast from that budget, and that cash flow forecast will actually help you forecast your balance sheet.
Great, thanks, Billie. Question 2, if you don't mind, I'm going to send that your way as well. Question 2 says, can I update my forecast during the year as things change?
Absolutely, absolutely. And you can imagine if in April or March you prepared your cash flow forecast and you take 2020, for example, if you didn't update your forecast for lockdown, your cash forecast for the remainder of the year is so out of date and unrealistic that the work that you put into that cash flow forecast at the beginning is not able to be utilised. So yes, I do recommend that for a fundamental change that you do update that during the year.
Awesome, thanks, Billie. Question 3, Lisa, I'm going to send this your way. What tools would BDO recommend for cash flow forecasting?
Thanks, Beck. If a lot of our clients are on Xero, so if that's the case, we commonly use Spotlight. Otherwise, we use Excel a lot, as you'd expect, and it works really well. We're commonly doing, quarterly cash flows, annually and 2 yearly.
Great, thanks, Lisa. And one more for you. We're already part way into the 2021 financial year. Is it too late to prepare a cash flow forecast?
Absolutely not. We prepare forecasts at all times during the year. We're in September, So I'll probably suggest that you start with a 6-month one to the end of the financial year, and then probably roll it out from there to the end of the 2022 year. So that would be a 6-month, then a 1 year. That will work really well.
Great, thank you, Lisa. Right, I think we are coming to the end now. So just on the final slide there, you will see Billie and Lisa's contact details. So there's a phone number and an email address, so feel free to give them a call or flick them an email anytime. So we'll wrap the webinar up there. Again, thanks everyone for attending, and look forward to hearing from you soon. Thank you.